In this short video, we will cover the asset side of the bank balance sheet. The most liquid assets banks have are so-called reserves. Reserves for all practical purposes are cash, although banks tend to not hold much cash in branches. Instead, most banks' liquid reserves are held in deposits with the Federal Reserve. These are so-called reserve deposits, and they fulfill a similar function for your bank as your checking account is for you. For this reason, central banks are sometimes referred to as bankers' banks because they act like a bank for banks. Banks hold reserves for two reasons. The first is that they have to, so-called required reserves. For each $1 in checking deposits banks issue, they need to hold a certain percentage, usually 10%, as a requirement in their accounts with the Fed. These 10% are called the required reserve ratio, and in the United States that has been steady for decades. It doesn't really ever change. Required reserves are another fail-safe that makes sure banks have at least some cash in case a lot of depositors decide to withdraw their funds simultaneously. The second reason why banks are holding reserves is because they choose to. Such reserves are referred to as excess reserves. These too can be stored with the central bank in reserve deposits, or they could be held in bank branches, which are also called vault money, because banks obviously have vaults for that. Checks in the process of clearance and deposits with other banks may also fall into this category, although they make up for a smaller fraction of bank reserves overall. For the most part, banks store liquidity with the Federal Reserve. For pretty obvious reasons, it's safer to do so, and if they have to make a payment to another bank, those payments can simply be settled at the Fed instead of shipping money around. There is no bag with a big dollar sign required in practice. Now, why do banks hold excess reserves? Well, one, banks need to satisfy withdrawals. If you want to go to the ATM and take out money, the bank needs to be able to satisfy that, so they need some cash at hand for that. Otherwise, banks would normally not want to hold a lot of reserves because cash pays no interest and is thus not profitable for banks. However, as interest rates have approached a zero bound and as inflation rates have been fairly low, banks have increasingly held on to the liquidity in most developed countries over the past 10, 15, 20 years. The reason here is that lending is risky and that interest rates may simply not be high enough to compensate banks for taking on additional risk. This too is a result of the liquidity trap situations we've discussed earlier. The first kind of profitable assets that banks hold on a balance sheet, the most liquid one, are so-called securities, and for the most part that means bonds, but not entirely. Banks are heavily restricted by regulators in the types of risks they can take on due to their central macroeconomic role. For instance, commercial banks cannot hold stock or high-yield bonds. Generally, therefore, banks hold one of the three types of assets: U.S. government securities or agency securities. Those are securities issued by Freddie Mac, Fannie Mae, or Ginnie Mae. I'll talk about them more in the next video. If you're not familiar with them, don't worry about it for now. The second type of security that banks can hold are municipal securities. That means state or local government, depending on how they're rated, so they also need to have a high credit quality. Although the primary lender in this segment are typically households because they receive a favorable income tax treatment, as we had discussed at an earlier point. Finally, banks may hold other types of securities that include certain securitized assets, and again, we will return to this point in the next video. Since treasury and agency debt are highly liquid, they are also sometimes referred to as second reserves because they're easily turned into cash. Financial intermediaries, when they're strapped for liquidity, are usually able to raise some by selling off these assets with a quick turnaround. The primary source of traditional revenue for banks are loans, and especially real estate loans, although other segments like commercial and industrial, so-called C&I loans, or consumer loans are also important market segments. Loans are obviously typically not liquid. A mortgage, for instance, may have a maturity of up to 30 years and can be more difficult to sell than, say, commercial paper. Loans also obviously have significant default risk. Consequently, banks screen and monitor mortgage borrowers, or borrowers in general I should say, and require higher interest. This interest, minus the interest banks pay on certificates of deposits or other loans, is known as the interest rate margin. And the interest margin is the main source of traditional bank profitability. Finally, just as a final thought, banks keep some other physical assets, like for instance nice buildings downtown or art collections, to store value over time. It's one of the reasons why dead artists tend to be valuable more than living artists often, because supply is limited. So banks will buy a Van Gogh to store some value. If you're a current successful painter, they may be less inclined to do so because you can always paint more, which would reduce the value of your asset.